There is a street in New York that is less than a kilometer long. It has no gardens. It has no tourist attractions. It has nothing to justify its fame, except what happened there and what still happens every day. Wall Street. The name evokes fortune and ruin, power and crisis, ambition and consequence. But how did a narrow street in a city that didn't even exist 300 years ago become the financial heart of the planet? This is not the story of an institution. It is the story of a country that had to reinvent itself from scratch, and, in doing so, created the most powerful financial system in the history of humankind. In this documentary, you will follow this journey from the beginning. 24 brokers gathered under a tree on a morning in May 1792. An informal agreement, a signature, and the embryo of what would become the largest stock exchange in the world. You will understand how wars shaped markets, how the richest men in American history used Wall Street to build empires, and how, at times, a single banker had more power than the United States government itself. You will see how crises, and there were many, did not destroy the system. On the contrary, each collapse generated new rules, new institutions, new ways of speculating. And you will understand why, after World War II, the dollar became the language of money throughout the world. But this story doesn't end in the past. Today, Wall Street faces its greatest challenges: cryptocurrencies, fintech, artificial intelligence, and a world that is beginning to question whether a single place can, or should, still control so much. The answer isn't simple. And that's precisely why this story is worth telling. To understand Wall Street, you need to forget the skyscrapers for a moment. Forget the screens flashing with numbers, the traders shouting on the trading floor, the billions that change hands in fractions of a second. You need to go back to a very different city. New York, 1792. A city of just over 30,000 inhabitants. Cobblestone streets, when there were streets. The smell of salt, fish, and smoke. A bustling port, where goods arrived from Europe and raw materials left from the New World. New York was a commercial city. Busy. Ambitious. But it was by no means a financial center. That role, at that time, belonged to Philadelphia, the seat of government, the Bank of the United States, and the main institutions of the newly born country. New York was just another port. The very name of the street says a lot about its origins. Wall Street, the name comes from a wooden barrier built by Dutch colonists in the 17th century to protect the settlement from attacks. The wall was torn down decades earlier, but the name stuck. It was a street of modest businesses, auctions of goods, buying and selling of slaves, small transactions between merchants. Nothing that suggested what was to come. It was under a tree that it all began. A buttonwood, an American sycamore, planted on the sidewalk of number 68 Wall Street. In its shade, on May 17, 1792, 24 brokers and traders gathered. There was no headquarters. There was no regulation. There was no government oversight. There was only one problem to solve. The stock and bond market in New York was chaotic. Anyone could buy and sell whatever they wanted for whatever price they wanted without any rules or guarantees. Scams were common. Trust was scarce. So these 24 men signed a simple document with only two essential clauses. The first, they would trade securities and stocks only among themselves, without intermediaries outside the group. The second, they would charge a minimum commission fixed at 0.25% on all transactions. Two rules. One signature. A tree as witness. What seemed like an informal agreement between traders was, in fact, much more than that. It was the birth certificate of Wall Street. For the first time, an organized group took control of the New York financial market. It created rules. It excluded outsiders. It protected insiders. It established trust where there had previously been chaos. It's the same principle that moves markets to this day, albeit on an infinitely larger scale. The Buttonwood Agreement didn't create the New York Stock Exchange immediately. That would take a few more years. But it planted the seed. In 1817, the already formalized group moved into its own building, adopted stricter statutes, and became known as the New York Stock and Exchange Board, the direct embryo of the NYSE, which exists to this day. From the tree to the building. From the informal agreement to the world's largest stock exchange. But to understand why New York, and not Philadelphia, not Boston, not any other city, was chosen by destiny to host all this, it is necessary to understand what was happening behind the scenes of the young American government. Because even before the Buttonwood Agreement, someone was already building the financial foundation that would make it all possible. His name was Alexander Hamilton. Alexander Hamilton was never a man of privileged origins. He was born in the Caribbean, an illegitimate child, orphaned at a young age. He arrived in the American colonies without family, without money, and without a name. What he did have was intelligence, and an understanding of economics that few Americans of his time possessed. When the War of Independence ended in 1783, the United States celebrated freedom. But there was a silent, enormous problem that threatened to destroy the country before it could even consolidate: the debt. To finance the war against England, the American government had borrowed money from everyone. From the states themselves. From private investors. From France. From Holland. The total was astronomical for the time, about $54 million in federal debt, plus another $25 million accumulated by the states individually. And the government had no way to pay. There was no central bank. There was no reliable unified currency. There was no efficient tax collection system. The country was, financially, a patchwork quilt on the verge of falling apart. It was then that George Washington appointed Hamilton as the first Secretary of the Treasury of the United States. Hamilton was 34 years old. And what he did in the following years would forever change the relationship between the American government and the financial markets. Hamilton's first big idea was also the most controversial. The federal government should assume all war debts, both federal and state. Unify the liabilities. Make the United States a single, solid, reliable debtor. Many were against it. The states that had already paid off their debts were furious. Why should they help pay the debt of others? Thomas Jefferson and James Madison led the opposition. Congress rejected the proposal in the first vote. Hamilton did not give up. What followed was one of the most famous agreements in American history, made not in a parliament but at a dinner party. Hamilton personally negotiated with Jefferson and Madison support for his debt consolidation plan in exchange for support for building the new federal capitol on the banks of the Potomac River, far from New York, far from Philadelphia. Politics and economics combined over a dinner table. The plan passed. To honor this consolidated debt, the government issued bonds, papers that promised future payment with interest. It was a bet on the credibility of a country that hadn't even proven it deserved credit. But it worked. American and European investors bought these bonds. And where were they traded? On the streets of New York. In cafes. At impromptu auctions. In the hands of the same brokers who, 2 years later, would meet under the Buttonwood Tree. Hamilton had created, almost from scratch, a market for American government bonds. And with it, the urgent need for an organized financial system to support it. But Hamilton didn't stop there. In 1791 he proposed the creation of the Bank of the United States, a mixed institution with private capital and government participation, inspired by the Bank of England. It would be the guardian of federal reserves, the issuer of a more stable currency, the nerve center of the new country's finances. The opposition was fierce. Jefferson and the landowners saw the bank as a threat to liberty, an instrument for concentrating power in the hands of a few. They argued that the Constitution did not give the federal government the right to create such an institution. Hamilton responded with one of the most influential documents in American economic history, an opinion in which he defended the so-called implied powers of the federal government. If the Constitution gave Congress the power to regulate commerce and mint currency, then creating a bank to fulfill these functions was legitimate. Washington agreed. The bank was created. And the result was immediate. The shares of the Bank of the United States were launched to the public, and were bought in minutes. There was speculation, euphoria, and soon after a small bubble and its inevitable correction. It was the first financial crisis in American history. Small, controlled, but a clear warning of everything that would come later. Hamilton intervened, using the Treasury to buy bonds and stabilize the market. It was also the first time the American government used public money to contain a financial crisis, a model that would be repeated throughout the history of Wall Street. Hamilton would not live to see the size of what he had built. In 1804 he died in a duel against Aaron Burr, his longtime political rival. He was 49 years old, but the system he designed survived. The logic that the government should have an active role in financial markets, creating rules, issuing debt, intervening in crises, became the DNA of the relationship between Washington and Wall Street. A tense, ambiguous, and inseparable relationship which lasts to this day. The American market was being born, and it needed fuel to grow. That fuel would arrive by rail. At the beginning of the 19th century, the United States was a country of farms, forests, and rivers. Most people had never traveled more than a few dozen miles from where they were born. The country was vast, and that vastness was both its greatest promise and its greatest obstacle. To grow, the United States needed to connect. And the answer came on rails. The railroad wasn't just a means of transportation. It was the first big business in American history, the first industry that required capital on a scale that no single investor could manage alone. Building a railroad meant buying land, importing steel, hiring thousands of workers, maintaining operations for years before seeing the first penny of return. It was too expensive for one man, and too cheap to be ignored by a market. In the 1830s, the first railroad lines began to appear on the East Coast. Small, modest, connecting neighboring towns. But the appetite grew quickly. By 1840, there were about 4,000 kilometers of track in the United States. In 1860, that number had jumped to over 48,000 kilometers, the largest rail network in the world. Someone had to pay for all of that. And it was Wall Street that found the answer. The railroads transformed Wall Street from a market for government bonds into a market for private capital, and that change was decisive. Until then, what was traded in New York were mainly government bonds. Hamilton's debt, federal and state bonds. The private sector had little presence in the organized financial market. The railroads changed that forever. To raise the necessary capital, railroad companies began issuing stocks and private bonds on a large scale. For the first time, an ordinary citizen could buy a fraction of a railroad and profit from the country's growth. The New York Stock Exchange ceased to be a closed club of specialists and began to attract a wider audience. The volume of trading exploded. New brokers emerged. Newspapers began publishing daily quotes. Wall Street gained a new dimension. It was no longer just the place where the government raised funds. It was the place where America's future was financed. And the future at that time was called continental expansion. With the capital raised on the stock exchanges, the railroads advanced westward. They connected the Mississippi to the Atlantic. They opened the interior of the country to commerce, to agriculture, to immigration. Entire cities sprang up along the tracks. Regional economies that existed in isolation became part of an integrated national market. Wall Street didn't just finance the railroads. Wall Street financed the United States as a unified economic nation. Where there is money in motion, there are those who know how to move it better than others, and those who know how to take advantage of it. The railroads created both types. On one side, the first great investors in American history emerged. Men who understood the potential of railroads before others and bet heavily. Some became legitimately rich, building real companies that connected real cities. On the other side, the speculators emerged. Men who were not interested in the railroads themselves but in the role a railroad played. They bought stocks, inflated prices with rumors and insider information, sold at the peak and disappeared before the bubble burst. The market still lacked clear rules. There was no regulatory body. There was no obligation for transparency. A company could issue shares in a railroad that barely existed on paper, and there were buyers willing to believe it. The most emblematic name of this period was Cornelius Vanderbilt. He started in shipping, moved to railroads, and amassed a fortune building and consolidating railroad lines in New York and the northeast of the country. He was ruthless, aggressive, and absolutely brilliant at understanding how to use the financial market to his advantage. Vanderbilt was not the only one. Around him and others like him, a new class formed. That of men who did not produce steel, did not plant wheat, did not build anything with their own hands, but who controlled who produced, who planted, and who built. It was American capitalism finding its purest and, at the same time, most savage form. And the worst, or the best depending on your point of view, was yet to come. Because after the Civil War, these men would have no more restraints. And Wall Street, unregulated and without limits, would become the stage for an era of power, excess, and scandal that would never be forgotten. After the Civil War, the United States entered a period of unprecedented growth. The country had survived the greatest crisis in its history and emerged from it with an economy hungry for expansion. Railroads pushed forward. Factories multiplied. Cities exploded in population and ambition. And in that environment, a handful of men took advantage of the absence of rules to accumulate a kind of power that had never before existed in the hands of private citizens in American history. History would call them the robber barons. Cornelius Vanderbilt was already there, dominating the northeastern railroads with an iron fist. But around him, others emerged, each building their empire in a different sector, each using Wall Street as their central instrument of power. Andrew Carnegie arrived in the United States as a child, a penniless Scottish immigrant. Decades later, he controlled the largest steel producer in the world. His fortune was built on brutal efficiency, wage suppression, and a relentless ability to eliminate competitors. Rockefeller did the same with oil. He founded Standard Oil in 1870 and within less than a decade, controlled more than 90% of all oil refining in the United States. Not through brute force but through something more sophisticated. Secret deals with railroads to secure lower freight rates than his competitors, forced acquisitions, and a strategy of predatory pricing that drove rivals into bankruptcy before they could fight back. And then there was J.P. Morgan. Unlike the others, Morgan built no factories and drilled no wells. His domain was money itself. A banker and financier, he was the man who moved the capital that moved everything else. Morgan financed companies, reorganized bankruptcies, and consolidated entire industries with a cold precision and strategic vision that few could match. Together, these men did not merely dominate their own sectors. They dominated the entire American economy. And Wall Street was the place where that dominance was expressed, negotiated, and perpetuated. Without regulation, the financial market of that era was a territory where the most powerful simply did as they pleased. And what they pleased most of the time was more power. Market manipulation was open and frequent. Groups of investors would coordinate to buy shares in a company, artificially inflate the price, lure in unsuspecting buyers, and then sell everything at once, leaving small investors holding paper worth nothing. Was it a crime? There was no law that said it was. The most scandalous episode came in 1869, when two speculators, Jay Gould and James Fisk, attempted to corner the entire gold supply of the United States. The plan was simple in its audacity: buy gold in massive quantities, drive the price up, and sell at the peak before the government could intervene. To ensure the government would not interfere, they bribed a brother-in-law of President Ulysses Grant to block any gold sales by the Treasury. The scheme worked for weeks. Gold prices soared. Then the government discovered the plot and flooded the market with gold all at once. Prices collapsed within minutes. Hundreds of traders went bankrupt. That day became known as Black Friday, the Black Friday of 1869. It was not the only scandal. There were dozens across different sectors with different protagonists. Corporate warfare waged not in factories but in trading floors and courtrooms. Hostile takeovers. Secret agreements. Bribes to politicians and judges. Monopolies grew unchecked. Rockefeller's Standard Oil was the most visible example, but monopolies existed in steel, railroads, tobacco, and sugar. Entire sectors of the American economy controlled by a single company, or a single man. The problem was not merely moral. It was systemic. A market without rules is not a free market. It is a market where the most powerful write the rules for themselves, and use that advantage to crush any competition before it can grow. Workers in Carnegie's factories worked 12 hours a day, 6 days a week for subsistence wages. When they tried to organize into unions, they were fired, replaced, or in extreme cases confronted by armed private security. The Homestead Massacre of 1892 made that brutally clear. Striking steelworkers faced agents hired by Carnegie Steel, and the result was dead on both sides. The concentration of wealth reached levels that most Americans could barely imagine. By 1890, it is estimated that fewer than 4,000 families controlled more wealth than the other 11 million American families combined. Public opinion began to shift. Journalists, known as muckrakers, began investigating and exposing the inner workings of the great monopolies. Ida Tarbell revealed the practices of Standard Oil in a series of reports that shocked the nation. The book that resulted from her investigation is still considered one of the greatest works of investigative journalism in American history. Public pressure mounted. And the government, which had looked the other way for decades, was forced to act. In 1890, Congress passed the Sherman Antitrust Act, the first American law to prohibit monopolies and anti-competitive practices. It was a beginning, weak, poorly enforced in its early years, but a beginning nonetheless. Wild capitalism had created extraordinary wealth. It had also created extraordinary inequality, systemic corruption, and a financial market that operated like a private casino for the very rich. Something had to change. And the change would come, but not from the government. It would come, first, from a single man who had already appeared in this story, and who was about to show the entire world just how much power one person could hold: J.P. Morgan. By the 1890s, J.P. Morgan was already the most powerful banker in America. But no one fully understood the scale of that power until the country found itself on the edge of complete financial collapse. It started with the railroads. Throughout the 1880s, hundreds of railroad companies had expanded recklessly, taking on massive debt and making promises they could not keep. When the bills came due, the entire system began to crack. In 1893, a wave of railroad bankruptcies triggered a panic that spread through the entire economy like wildfire. Banks failed, businesses closed, unemployment soared. Nearly 500 banks collapsed in a single year. The country was in free fall. And the federal government was broke. The United States Treasury had been bleeding gold reserves for months. The government was dangerously close to defaulting on its own debt, unable to honor the promise that every dollar in circulation could be exchanged for gold. If that happened, the consequences would be catastrophic. A total loss of confidence in American currency both at home and abroad. President Grover Cleveland had no good options. Congress would not act fast enough. The financial system had no safety net. So Cleveland did something that would have been unthinkable in any other era. He called on a private citizen to bail out the United States government. He called J.P. Morgan. Morgan and a partner arranged a deal that was remarkable in its simplicity and its audacity. A private syndicate would supply the Treasury with $62 million worth of gold in exchange for government bonds. The deal stabilized the reserves, stopped the bleeding, and restored just enough confidence to keep the system from collapsing entirely. A private banker had just rescued the United States Treasury, and almost no one was comfortable with what that meant. 14 years later, it happened again. In October 1907, a failed attempt to corner the stock of a copper mining company triggered a chain reaction that nobody could stop. Depositors panicked and rushed to pull their money out of banks. Trust companies, financial institutions that operated with even less oversight than regular banks, began to fail one after another. The New York Stock Exchange was on the verge of shutting down entirely. Brokerage firms were running out of money to honor their obligations. The entire financial system was hours away from seizing up. There was no Federal Reserve. There was no government mechanism to inject liquidity into the markets. There was no playbook for this kind of crisis. There was only Morgan. At 70 years old, J.P. Morgan summoned the most powerful bankers and financiers in New York to his personal library, a magnificent room lined with rare books and Renaissance art on Madison Avenue. He sat them down, locked the door, and refused to let anyone leave until they had agreed on a plan. Over several sleepless nights, Morgan personally coordinated the rescue. He decided which banks were worth saving and which were not. He organized pools of money from the major banks to shore up the failing ones. He convinced John D. Rockefeller and other wealthy men to deposit millions into struggling institutions to stop the runs. He even arranged a bailout for New York City itself, which was days away from being unable to meet its own payroll. When it was over, the panic had been contained. The financial system had survived. One man in his private library had done what no government institution was equipped to do. Morgan was celebrated as a hero. And he was, in the most literal sense. Without him, the damage would have been far worse. But across the country, a deeply uncomfortable question was growing louder. If one private citizen had enough power to single-handedly rescue the American financial system, twice, then what did that say about the system itself? It meant that the fate of millions of ordinary Americans, their savings, their jobs, their livelihoods, depended not on elected officials, not on public institutions, but on the mood, the judgment, and the goodwill of a single unelected banker. Morgan had never stood for office. He was accountable to no one. He had no legal obligation to step in during a crisis. He simply chose to because it served his interests and, in his own view, the interests of the country. But what would have happened if he had chosen differently? What would happen when he was gone? The answer came sooner than expected. Morgan died in 1913 at the age of 75, leaving behind an estate worth the equivalent of billions of dollars in today's money. Upon hearing of Morgan's wealth, John D. Rockefeller reportedly remarked that Morgan was not, after all, a rich man. But before Morgan died, the country had already begun drawing the only logical conclusion from what his career had demonstrated. The United States could not keep relying on one man to hold the financial system together. It needed an institution. A permanent, public mechanism that could do what Morgan had done, but with accountability, with oversight, and without the terrifying concentration of power in private hands. The country needed a central bank. And creating one would require a level of secrecy that felt more like a spy novel than a chapter in the history of American finance. It was November 1910. A group of men arrived at a train station in Hoboken, New Jersey in the middle of the night. They came separately using only first names. They carried no luggage that could identify them. Some had never met in person before, and yet they were about to make one of the most consequential decisions in American financial history. They boarded a private rail car and traveled south for 2 days. Their destination, Jekyll Island, a secluded retreat off the coast of Georgia, accessible only by boat, owned by a private club whose members included some of the wealthiest families in America. The men who gathered there represented an almost incomprehensible concentration of financial power. Among them were Nelson Aldrich, the most influential senator on banking matters in Congress, Frank Vanderlip, president of National City Bank, Paul Warburg, a prominent banker who had emigrated from Germany and brought with him a deep understanding of European central banking, and representatives of J.P. Morgan's financial empire. Together, they controlled an estimated 1/4 of the world's entire wealth. For 9 days behind closed doors, they drafted the blueprint for what would become the Federal Reserve System. They debated structure, debated control, debated how to present their creation to a public that was deeply suspicious of concentrated financial power. They knew that if the plan was seen as a product of Wall Street, designed by bankers for bankers, it would never pass Congress. So they kept it secret. For years, the meeting was denied entirely. It was only decades later that participants began to acknowledge what had happened on Jekyll Island, and by then the Federal Reserve had already reshaped American finance beyond recognition. To understand why this meeting had to happen in secret, you have to understand just how deep the American distrust of central banking ran. It went all the way back to the beginning. Alexander Hamilton's Bank of the United States had been controversial from the moment it was proposed. Thomas Jefferson and his allies saw it as a dangerous concentration of power, a tool of the elite that would benefit wealthy financiers at the expense of ordinary farmers and workers. When the bank's charter expired in 1811, Congress chose not to renew it. A second Bank of the United States was created in 1816, but it faced the same hostility. President Andrew Jackson made destroying it the defining cause of his presidency. In 1832, he vetoed the renewal of its charter with a message that was as much a populist political speech as it was a policy decision. The bank, he argued, was a monster that served the rich and powerful at the expense of the American people. Jackson won that fight. The second bank died. For the next 75 years, the United States was one of the only major industrialized nations without a central bank. And the consequences were painfully clear. Financial panic struck with alarming regularity in 1837, 1857, 1873, 1893, and finally 1907. Each one caused widespread suffering. Each one exposed the same fundamental weakness. Without a lender of last resort, the financial system had no shock absorber. The panic of 1907 was the breaking point. Even those who feared central banking could no longer deny that something had to change. Leaving the stability of the entire financial system in the hands of one private banker was not a solution. It was a catastrophe waiting to happen. The question was no longer whether the United States needed a central bank. The question was what it would look like, and who would control it. The Federal Reserve Act was signed into law by President Woodrow Wilson on December 23, 1913. It was a compromise in almost every sense of the word, a system designed to satisfy those who feared Wall Street domination while still being functional enough to serve the needs of the financial industry. Rather than a single central bank headquartered in New York, which would have been seen as handing control directly to Wall Street, the Fed was structured as a network of 12 regional reserve banks spread across the country, overseen by a board in Washington. It was decentralized by design, meant to represent not just the financial elite of the East Coast, but the farmers, merchants, and industrialists of the entire nation. In practice, the New York Federal Reserve Bank quickly became the dominant force within the system. Its proximity to Wall Street, its relationships with the major financial institutions, and the sheer volume of transactions it oversaw meant that what happened in New York shaped what happened everywhere else. For Wall Street, the creation of the Fed was transformative in ways that went far beyond crisis management. For the first time, banks had a lender of last resort, an institution that could provide liquidity in moments of panic and prevent the kind of cascading failures that had brought the system to its knees in 1907. The chronic instability that had defined American finance for over a century now had, at least in principle, a remedy. The Fed also gave the government a new instrument of economic policy, the ability to influence interest rates, control the money supply, and shape the broader direction of the economy. It was a profound shift, from a financial system that largely governed itself for better or worse, to one where public institutions played a permanent and central role. Wall Street would never again operate entirely on its own terms. But new tools also created new risks. And the men of Wall Street, never short on creativity, would find ways to use the new system to build something the world had never seen before. A decade of boundless prosperity, reckless speculation, and blind optimism that would end in the worst economic catastrophe in modern history. The roaring 20s were just around the corner. After the First World War, America was ready to celebrate. The boys had come home. The economy was booming. Technology was changing everyday life at a pace that felt almost miraculous. Automobiles, radios, refrigerators, telephones, things that had been luxuries a decade earlier were becoming ordinary. American factories were producing more goods than ever before. American consumers were buying them as fast as they could be made. And American investors were riding a wave of optimism that seemed like it would never break. The stock market became, for the first time in American history, a truly mass phenomenon. Before the 20s, investing in stocks was largely the domain of the wealthy and the professional. But in this new era of prosperity, ordinary Americans, teachers, shopkeepers, factory workers, housewives, began putting their savings into the market. Brokerage offices opened on main streets across the country. Newspapers published stock tips alongside the weather forecast. Dinner table conversations turned to hot stocks and market predictions. Between 1920 and 1929, the Dow Jones Industrial Average rose by almost 500%. Companies that had barely existed a few years earlier were worth hundreds of millions of dollars. Radio Corporation of America, RCA, became the symbol of the era, a stock that seemed to do nothing but go up, fueled by the excitement of a technology that was genuinely changing the world. The mood was intoxicating. Economists declared that America had entered a new era of permanent prosperity. One of the most respected financial minds of the time famously proclaimed, just days before everything fell apart, that stock prices had reached what looked like a permanently high plateau. Nobody wanted to hear bad news. And for a while the bad news politely stayed away. Beneath the euphoria, a dangerous mechanism was quietly building pressure. Buying on margin. The concept was simple and seductive. Instead of paying the full price of a stock, an investor could put down a fraction of the cost, sometimes as little as 10%, and borrow the rest from their broker. If the stock went up, the profits were calculated on the full value of the shares, not just the amount actually invested. The returns could be extraordinary. It felt like free money. And in a rising market it nearly was. By the late 1920s, margin buying had become widespread. Billions of dollars worth of stocks were being held on borrowed money. Brokers were lending freely, banks were lending to brokers, and the entire system was stacked on a foundation of debt that only made sense as long as prices kept going up. But margin buying had a brutal flip side. If a stock fell far enough, the broker would issue what was called a margin call, a demand for the investor to immediately deposit more money to cover the loss. If the investor could not pay, the broker would sell the shares automatically, at whatever price the market would bear. In a falling market, this created a catastrophic feedback loop. Falling prices triggered margin calls forced selling pushed prices down further, which triggered more margin calls, which forced more selling. A decline could become a collapse almost overnight. And there was something else building beneath the surface. Throughout the late 20s, a growing number of Wall Street insiders could see that many stocks were trading at prices that had no connection to the actual value of the underlying businesses. The market had detached from reality. It was running on faith, momentum, and borrowed money. The time bomb was ticking. Most people just could not hear it. It began with a tremor. In September 1929, the market showed its first signs of strain. Prices wobbled. A few investors, nervous about the heights the market had reached, began quietly selling. Nothing dramatic, just enough to introduce a note of uncertainty into what had been an almost unbroken climb. Then in the third week of October, the tremor became an earthquake. On October 24th, a day that would go down in history as Black Thursday, the market opened and immediately began to fall. Panic spread across the trading floor. Sell orders overwhelmed buy orders. Prices dropped so fast that the ticker tape machines that transmitted stock prices across the country could not keep up. Investors watching the tape had no idea what their shares were actually worth, only that the numbers were going in one direction. A group of senior bankers, in the tradition of J.P. Morgan, pooled their resources and sent a representative to the floor of the New York Stock Exchange to make highly visible purchases of major stocks. The gesture worked briefly. The market stabilized for a day or two. Then it fell again. On October 28, Black Monday, the Dow fell nearly 13% in a single day. On October 29, Black Tuesday, it fell another 12%. In 2 days, billions of dollars of wealth simply ceased to exist. The margin calls came in waves. Investors who had borrowed to buy stocks were wiped out. Those who had not borrowed watched their savings evaporate anyway. Banks that had lent money to brokers found themselves holding loans that could never be repaid. One by one, banks began to fail. Between 1929 and 1933, nearly 10,000 banks closed their doors across the United States. Unemployment went from 3% to 25%. Industrial production collapsed by half. Families who had been comfortable a few years earlier were standing in breadlines. The Great Depression had begun. And as the country sifted through the wreckage, trying to understand how a decade of prosperity had ended in ruin, one conclusion was unavoidable. The financial system had been allowed to run wild for too long. The speculation, the borrowed money, the lack of transparency, the absence of meaningful oversight, all of it had built a structure that was never going to stand. Someone was going to have to rebuild it from the ground up. That someone was already on his way to Washington. Franklin Delano Roosevelt took office on March 4, 1933, in the darkest moment of the Depression. 1 in 4 Americans was out of work. Banks were failing at a rate that made the news almost impossible to follow. In the days before his inauguration, so many banks had collapsed or suspended operations that several states had simply declared bank holidays, closing every financial institution within their borders to stop the bleeding. Roosevelt's first act as president was to declare a national bank holiday, shutting down every bank in the country for 4 days while his administration worked out a plan to stabilize the system. Then he went on the radio. In the first of what became known as his fireside chats, Roosevelt spoke directly to the American people in plain, calm language. He explained what had happened to the banks, what the government was doing about it, and why it was safe to put money back into the system. It was a masterclass in restoring confidence, and it worked. When banks reopened, deposits exceeded withdrawals for the first time in years. But Roosevelt understood that confidence alone was not enough. The system that had produced the crash of 1929 was still largely intact. The speculation, the lack of transparency, the conflicts of interest that had allowed Wall Street to operate as both a financial marketplace and a rigged game for insiders, none of that had been addressed. The New Deal set out to change that. Over the next several years, a wave of legislation reshaped the relationship between the government, the banks, and the financial markets in ways that would define American finance for generations. It was not a revolution. Roosevelt was not trying to destroy capitalism. He was trying to save it, by giving it rules it had always refused to impose on itself. One of the most revealing investigations of the early 1930s was a series of Senate hearings led by a lawyer named Ferdinand Pecora. What Pecora uncovered was staggering. The nation's most prestigious banks had been selling securities they knew were worthless to their own clients. Executives had awarded themselves massive bonuses while their institutions collapsed. Insiders had traded on information the public never had access to. Some of the most respected names on Wall Street had engaged in practices that were not merely unethical. They were deliberate fraud carried out in plain sight, because there was no one with the authority to stop them. The Pecora hearings changed public opinion almost overnight. The image of Wall Street as the engine of American prosperity gave way to something darker. A closed system designed by insiders for insiders at the expense of everyone else. Roosevelt's response was the Securities Act of 1933 and a year later, the Securities Exchange Act of 1934, the law that created the Securities and Exchange Commission. The SEC was a genuinely new idea in American financial life. For the first time, there was a federal agency with the explicit mandate to oversee the securities markets, to require companies to disclose accurate financial information to the public, to investigate fraud, and to punish those who manipulated the market or deceived investors. Wall Street finally had a sheriff. To lead the new agency, Roosevelt made a choice that surprised almost everyone. He appointed Joseph Kennedy, a man who had made a considerable fortune through exactly the kind of aggressive, ethically questionable trading the SEC was created to prevent. Roosevelt's reasoning was blunt and entirely practical. It takes a thief, the thinking went, to catch a thief. Kennedy knew every trick in the book, which made him uniquely qualified to write the rules that would outlaw them. The appointment worked. Kennedy served for just over a year, but in that time he established the SEC as a credible, functional institution, one that Wall Street could not simply ignore or steamroll. But the most consequential piece of financial legislation of the New Deal era had actually been passed even before the SEC was created. The Glass-Steagall Act became law in June 1933, and it drew a hard line through the middle of American banking. On one side, commercial banks. The institutions where ordinary Americans kept their savings, took out mortgages and borrowed money to start businesses. These banks were backed by federal deposit insurance, a new guarantee that if a bank failed, depositors would get their money back, up to a certain limit. For the first time, an ordinary American could put money in a bank without lying awake at night wondering if it would still be there in the morning. On the other side, investment banks. The firms that underwrote securities, traded stocks and bonds, and engaged in the kind of speculative activity that had helped inflate the bubble of the 1920s. Glass-Steagall said these two worlds could not coexist within the same institution. A bank had to choose. It could take deposits and make loans, or it could play the markets. It could not do both. The reasoning was straightforward. When commercial banks, holding the savings of ordinary Americans, were also engaged in speculative investment activity, the risks of Wall Street became the risks of Main Street. When the bets went wrong, it was depositors who paid the price. Glass-Steagall was designed to build a firewall between the two. For decades it held. The financial system that emerged from the New Deal was not perfect. It was slower, more cautious, and more constrained than what had come before. Some argued it was too restrictive, that it held back growth and innovation. But it was also, by almost any measure, more stable. Between the mid-1930s and the late 1970s, the United States did not experience a single systemic banking crisis. Not one. The rules of the game had finally been written, and for a generation they worked. But rules, in the world of finance, have a way of attracting people whose greatest talent is finding ways around them. That story would come later. First, the world had a war to fight, and when it was over, the United States would emerge in a position that no nation had ever occupied before. By the time World War II ended, Europe was in ruins. Its factories destroyed, its economy shattered, its governments drowning in debt. Britain, France, Germany, the powers that had dominated global finance for centuries, were too broken to lead anything. The United States was different. Its territory had never been bombed. Its factories had spent the war running at full capacity. It held more than half of the world's gold reserves. And it had the only major currency left standing. The war did not just make America powerful. It made America indispensable. In July 1944, representatives from 44 nations gathered at a hotel in Bretton Woods, New Hampshire. Their goal was to rebuild the global financial system from scratch, and to make sure the chaos of the 1930s never happened again. The agreement they reached was straightforward in its ambition. Every currency in the world would be pegged to the US dollar, and the dollar itself would be backed by gold at a fixed rate of $35 per ounce. The International Monetary Fund and the World Bank were created to support the system. In one weekend, the dollar became the world's reserve currency. The language of global trade, of international debt, of commodity prices, all of it would now be spoken in dollars. The consequences for Wall Street were profound and immediate. If the dollar was the world's currency, then the institutions that dealt in dollars, the banks, the brokerages, the financial markets of New York, were, by extension, the institutions that the world depended on. Foreign governments held dollars. International companies raised capital in New York. Global trade was settled through the American financial system. Wall Street had always been powerful within the United States. After Bretton Woods, it became powerful within the world. The question was no longer whether Wall Street was the center of global finance. The only question that remained was how long it could hold that position, and what it would do with it. On August 15, 1971, President Richard Nixon went on television and announced that the United States would no longer convert dollars into gold. Just like that, the Bretton Woods system was over. The reasons were practical. America had been spending heavily on the Vietnam War and on domestic programs, and foreign governments were quietly converting their dollar reserves into gold at a pace that was draining Fort Knox. Nixon had to act. But the consequences were enormous. For the first time in modern history, the world's major currencies were backed by nothing but confidence. Exchange rates, previously fixed, began to float freely, rising and falling with market forces every single day. It was a fundamental shift, and it opened the door to an explosion of financial creativity that Wall Street had never seen before. Floating exchange rates meant uncertainty, and uncertainty on Wall Street means opportunity. Financial engineers began designing new instruments to manage and profit from that uncertainty. Derivatives, contracts whose value was tied to the future price of currencies, commodities, or interest rates. Options, futures, swaps, tools that could be used to hedge risk or, in the hands of the aggressive, to make enormous speculative bets. At the same time, a new market emerged for junk bonds, high-yield, high-risk debt issued by companies that traditional banks would never touch. And hedge funds, loosely regulated investment vehicles for wealthy clients, began pursuing strategies that had no place in conventional finance. The financial world was becoming faster, more complex, and far more leveraged than anything the regulators of the New Deal era had imagined. Two names define this era more than any others. Michael Milken almost single-handedly built the junk bond market at Drexel Burnham Lambert, using high-yield debt to finance corporate takeovers on a scale that reshaped entire industries. He became one of the highest-paid individuals in Wall Street history, before being indicted for securities fraud and sentenced to prison in 1990. George Soros took a different path. Through his quantum fund, he made some of the most audacious macro bets in financial history. In 1992, he famously shorted the British pound with such force that he broke the Bank of England, pocketing over $1 billion in a single day and forcing Britain to withdraw from the European exchange rate mechanism. Together, Milken and Soros represented something new on Wall Street: the idea that individuals, armed with the right financial instruments, could move markets, and sometimes entire economies, on their own. The tools were getting more powerful. The stakes were getting higher. And the lessons of the past were getting harder to remember. In the mid-1990s, the internet arrived, and Wall Street lost its mind. The logic was seductive. This was a technology that would change everything. And in that sense, the logic was correct. What was wrong was the conclusion that followed: that any company with a website and a business plan was worth hundreds of millions of dollars, regardless of whether it had ever turned a profit or, in some cases, generated a single dollar of revenue. Venture capital poured into startups overnight. Companies went public with no earnings, no clear path to profitability, and valuations that defied any conventional measure of worth. The Nasdaq, home to most of the technology stocks, rose by more than 500% between 1995 and 2000. It was the 1920s all over again, the same euphoria, the same suspension of disbelief, the same certainty that this time was different. It never is. The bubble peaked in March 2000 and then began to deflate with stunning speed. One by one, the dot-com darlings collapsed. Companies that had been worth billions on paper simply ceased to exist. The Nasdaq lost nearly 80% of its value over the following 2 years, wiping out trillions of dollars in wealth and devastating the retirement savings of millions of ordinary Americans who had bought into the hype. Then came September 11, 2001, which sent an already wounded market into free fall. The lessons were familiar. Speculation detached from fundamentals always ends the same way. But rather than pausing to absorb those lessons, Wall Street was already moving on, channeling its energy and its appetite for risk into a new market that seemed, on the surface, far more grounded in reality than internet startups. That market was housing. The dot-com crash did not break Wall Street. It never does. Within a few years, the financial industry had regrouped, reorganized, and found new ways to generate the kind of returns that investors had come to expect during the boom years. New financial instruments, new markets, new strategies. The creativity that defined the era of financial innovation showed no signs of slowing down. If anything, the appetite for risk had grown. The crash had been painful, but it had also been survived. And on Wall Street, surviving a crisis has a way of making people feel invincible. That feeling would prove, in just a few years, to be the most dangerous thing of all. After the dot-com crash, the Federal Reserve slashed interest rates to historic lows. Cheap money flooded the economy, and much of it found its way into housing. Home prices began to rise, then rise faster, then rise in ways that stopped making sense. Banks, hungry for profit in a low-interest environment, began lending to borrowers who had no business receiving a mortgage. People with no income, no assets, and no realistic ability to repay. These were the subprime loans, high-risk mortgages dressed up and sold as opportunity. But the truly dangerous innovation was what happened next. Wall Street took those mortgages, bundled thousands of them together, and sliced them into complex securities called collateralized debt obligations, CDOs. The idea was that by pooling the risk, you could make something safe out of something dangerous. Rating agencies blessed these instruments with their highest ratings. Banks bought them, sold them, and built entire portfolios on top of them. It was an enormous, intricate machine built on a single assumption: that housing prices would never fall nationwide at the same time. They did. When housing prices began to drop in 2006 and 2007, the cracks appeared slowly at first, then all at once. Subprime borrowers defaulted. The securities built on their mortgages lost their value. The institutions that held those securities found themselves sitting on losses they could not absorb. Bear Stearns, one of Wall Street's oldest investment banks, collapsed in March 2008 and was sold for pennies on the dollar in a government-arranged rescue. It was a warning. And it was not enough of one. On September 15, 2008, Lehman Brothers, a firm with 158 years of history and over $600 billion in assets, filed for the largest bankruptcy in American history. The government, which had rescued Bear Stearns just months earlier, chose not to intervene this time. The consequences were immediate and global. Credit markets froze overnight. Banks stopped lending to each other because nobody knew who was holding how much toxic debt. Stock markets around the world collapsed. Companies that had nothing to do with mortgages or Wall Street suddenly could not access the credit they needed to meet payroll. In a matter of days, a financial crisis became an economic crisis, and it spread to every corner of the world. The response was unprecedented in its scale and its speed. The Treasury Department and the Federal Reserve moved together in ways that had no precedent in American financial history. The Troubled Asset Relief Program, TARP, authorized $700 billion to stabilize the banking system, purchasing toxic assets and injecting capital directly into failing institutions. The Fed slashed interest rates to near zero and began buying securities on a massive scale to keep credit flowing. The largest banks in America, institutions that had spent decades arguing against government interference, lined up to accept federal money. Some had no choice. Others saw an opportunity they could not pass up. The bailout worked in the narrow sense that the financial system did not completely collapse. But the anger it generated was deep and lasting. Ordinary Americans had lost their homes, their jobs, and their savings. The banks that had engineered the disaster were rescued with public money, and within a few years were recording record profits again. The question that hung over everything was the same one that had haunted Wall Street since the days of J.P. Morgan. How could a system this powerful, this central to the lives of ordinary people, be allowed to take risks this reckless, with consequences this catastrophic? The answer, or at least an attempt at one, came in 2010 with the Dodd-Frank Act, the most sweeping financial regulation since the New Deal. New rules, new oversight, new restrictions on the kind of risk-taking that had nearly brought the system down. Whether it was enough, nobody could say for certain. Because Wall Street, as history had shown time and time again, always finds a way. For most of its history, Wall Street's dominance was never seriously questioned. There was simply no alternative. If you wanted to raise capital, issue debt, trade securities, or move large amounts of money across borders, you needed the institutions, the infrastructure, and the relationships that only Wall Street could provide. That is no longer entirely true. In the past 2 decades, a wave of financial technology companies has built products that do, in simplified form, what Wall Street does: faster, cheaper, and without the need for a single person in a suit on the corner of Broad and Wall. Mobile apps let ordinary people invest in stocks, buy fractions of shares, and manage their finances without ever speaking to a broker. Payment platforms move billions of dollars daily outside the traditional banking system. Lending algorithms approve loans in minutes without a banker ever reviewing a file. And then there is crypto. Bitcoin, launched in 2009 in the immediate aftermath of the financial crisis, was explicitly designed as an alternative to the system that had just failed so spectacularly. A currency controlled by no government, no central bank, no Wall Street institution. Over the following decade, an entire ecosystem of cryptocurrencies, blockchain platforms, and decentralized financial products emerged, challenging, at least in theory, the fundamental premise that you need a trusted intermediary to move money and value between people. Whether crypto ultimately fulfills that promise remains an open question. But the fact that it exists at all, that millions of people around the world are actively exploring alternatives to the traditional financial system, is itself a sign that Wall Street's position is no longer uncontested. And yet, for all the disruption, the most striking feature of Wall Street today is not how much it has changed. It is how much power has concentrated into even fewer hands. The 2008 crisis, paradoxically, made the biggest banks bigger. As smaller institutions failed or were absorbed, the largest players emerged stronger. Today, just 4 American banks, JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup, hold assets worth more than the entire GDP of Germany. The top 6 banks control a share of the American financial system that would have been unthinkable even 30 years ago. The too-big-to-fail problem that haunted policymakers in 2008 has not been solved. In many ways, it has deepened. The institutions that the government could not afford to let collapse in 2008 are, today, even larger and more interconnected than they were then. At the same time, algorithmic trading, driven by artificial intelligence and machine learning, now accounts for the majority of daily trading volume on American stock exchanges. Decisions that once took human judgment now happen in microseconds, executed by systems that no single person fully understands. The market moves faster, more efficiently, and in ways that are sometimes impossible to predict or explain. Wall Street has always been powerful, but it has rarely been quite this concentrated, quite this automated, or quite this difficult for outsiders to see inside. We started this story under a tree. 24 men, a handshake, and 2 rules scratched onto a piece of paper. A modest agreement on a modest street in a city that was not even the most important in its own country. From that moment to this one, Wall Street has survived wars and depressions, panics and crashes, scandals and reforms. It has been rescued, regulated, deregulated, and rescued again. It has reinvented itself so many times that the institution bearing that name today would be almost unrecognizable to the men who gathered under the Buttonwood Tree in 1792. And through all of it, it has remained standing. But the world is changing in ways that are harder to read than anything that came before. The rise of China has produced financial markets of enormous scale and growing sophistication. Digital currencies are challenging the primacy of the dollar in ways that Bretton Woods never anticipated. Artificial intelligence is reshaping finance faster than regulation can follow. And a generation of young people who watched their families lose everything in 2008 carries a deep and enduring skepticism toward the institutions that were supposed to protect them. Will Wall Street still be the center of the financial world in 50 years? The honest answer is that nobody knows. History suggests it would be unwise to bet against it. But history also shows that nothing in finance is permanent, that every era of dominance eventually gives way to something new, something that the previous generation could not have imagined. What is certain is this: the story of Wall Street is, at its core, the story of human ambition. The drive to build, to grow, to accumulate, to innovate, and sometimes, to take risks that no one fully understands until it is too late. That story is not over. It never really is.